Something important shifted today, and if you blinked, you probably missed just how violent the move really was. What we are seeing now is not a rally, not a breakout in the usual technical sense, and definitely not a busy trading session. This is acceleration, the kind that happens when a market runs out of excuses and gravity suddenly points in only one direction. For months, the silver market has been held together by paper, leverage, and the collective belief that price suppression could continue indefinitely. We've said repeatedly that this wasn't a matter of opinion or conspiracy, but math. Paper contracts can only outnumber physical metal for so long before the imbalance becomes unmanageable. When that moment arrives, price doesn't rise politely. It doesn't stair-step higher. It goes vertical. That moment arrived today. Monday, January 12th, 2026, will be remembered as the day the chart stopped pretending. Silver surged to 85.37, up more than 6.7% in a single session. That number sounds dramatic, but it's not the most interesting part. Percentage gains are for headlines. Structure is what matters, and today's structure screams liquidation. Pull up the 30-minute intraday chart and tell me this looks normal. It doesn't. This is not enthusiastic buying. This is forced buying. This is what happens when shorts lose control and the clearing system starts doing the thinking for them. To understand why today was so explosive, you have to rewind to Friday, January 9th. That was the setup, the classic bear trap. Silver was smashed down to $74 in a sharp, aggressive move designed to do exactly what it always does: shake out weak hands, trigger stop losses, and convince late longs that the party was over. The narrative was familiar. The rally failed. Back to $60. Nothing to see here. That drop wasn't weakness. It was fuel. Every short that piled in at $74 is now staring at an $11 per ounce loss. Those positions are no longer trades. They're liabilities. And today, the bill came due. When markets reopened Sunday night, the tone changed immediately. We gapped up from $80 to $82 with no trading in between. No negotiation. No patience. Just buyers lifting offers. In technical terms, that gap is a sign of urgency. In plain English, it means someone didn't care about price. They cared about access. As the overnight session unfolded, the pattern was unmistakable. Up, pause, a staircase. That's not retail chasing candles from a phone app. That's institutional accumulation. Large players absorbing supply methodically, taking whatever metal appeared without spooking the market too early. Think sovereign funds, industrial users, or entities that don't ask for permission before they move size. But patience has limits. At 8 a.m. New York time, the U.S. market woke up and realized something uncomfortable. The price action overseas didn't line up with domestic pricing models. Algorithms did what they're programmed to do. They compared New York to Shanghai, discovered an $8 mispricing. That's when the tone flipped from calm accumulation to panic pursuit. Volume exploded. Green candles went vertical. Silver ripped through $84 and kept going until it printed $85.32. The final candle closed at the absolute high, with no upper wick. In technical analysis, that's significant. It means there was no selling pressure at the close. Buyers were willing to pay the highest price available just to get filled. That's not confidence, that's desperation. This is what a commercial short squeeze looks like when it happens in real time. Banks that were short at $74 aren't managing positions anymore. They're answering margin calls. Once losses cross certain thresholds, humans step aside and clearinghouse computers take over. Those systems don't negotiate. They don't care if the price is $85 or $95. Their only job is to close risk immediately, at whatever price the market demands. That's why moves like this feel violent. They are. And that's also why we need to stay level-headed. When markets accelerate this fast, volatility expands. A $2 or $3 swing is no longer meaningful. It's noise. Expect counterattacks. Expect engineered pullbacks. Banks don't surrender quietly. A retracement to $82 would not invalidate anything. It would simply be a back test of the breakout, a check to see whether former resistance has turned into support. That's healthy. It lets moving averages catch up and allows stronger hands to replace weaker ones. If you see a sharp dip, don't confuse volatility with failure. The real risk right now isn't buying too early. It's waiting for a dip that never comes. In genuine supply crises, markets don't always offer polite pullbacks. Sometimes they go limit up. And when that happens, trading halts. You can't buy. You can't react. You just watch the train leave while holding cash that buys less by the minute. The $85 level is critical because it represents the point where commercial short losses move from uncomfortable to existential. Above this zone, the problem stops being P&L and starts being solvency. That's why the fight here is so intense. The shorts aren't defending profits, they're defending balance sheets. And the chart suggests they're losing. The trend is no longer linear, it's exponential. Dips are being bought faster and faster. The traditional paper suppression playbook relies on flooding the market with contracts. Today, the market absorbed them and kept rising. When paper fails to push price down, physics takes over. Metal wins. So yes, technically speaking, the breakout is real. The $80 ceiling is gone. The $74 bear trap worked exactly as intended, just not for the people who said it. And $85 is now the battleground. But charts only tell us what happened. To understand why this is happening and where price is being pulled next, we have to look east. Because while traders in the US are fixated on $85, the real price of silver is flashing a very different number. China closed its trading day while New York was still rubbing its eyes. The Shanghai Gold Exchange printed its afternoon silver benchmark at 93.31. Read that again. 93.31. That's not a futures contract for delivery sometime next year. That's the spot price for physical metal in the world's largest manufacturing hub. An $8 spread between East and West isn't a curiosity. It's a vacuum. In a world where high-frequency algorithms fight over fractions of a cent, an $8 arbitrage gap is a black hole. Capital doesn't think about it. It rushes toward it. If you used to a global trading house or bullion bank and you see silver sitting in New York at $85 while buyers in Shanghai are paying $93, the trade couldn't be simpler. Buy the metal, ship it east, sell it. Even after insurance, transport, and security, you're locking in $6 or $7 per ounce. That's not speculation. That's logistics. And that trade is happening right now. Every available ounce in London and New York is being palletized, wrapped, and sent east. This drains liquidity from Western markets. COMEX inventories, already historically thin, are bleeding to feed the Shanghai premium. That leaves Western banks with two options. Option one, allow the arbitrage to continue until the vaults are empty, at which point force majeure declarations and contract failures become unavoidable. Option two, raise the price to close the gap. That's it. There's no third door. This is why $93 is a magnet. New York isn't rising because traders are excited. It's rising because it's being pulled. The price must move higher to stop the outflow of metal. If silver stays at $85 in the U.S., while Shanghai pays $93, the West runs out of silver. Full stop. This is the remonetization of silver led by the East. For decades, price discovery lived in London and New York, dominated by paper derivatives. China accepted the price. They were price takers. That dynamic flipped today. China is now the price maker, bidding aggressively because they need physical metal for solar, EVs, and strategic reserves. They don't want contracts. They want atoms. New York is playing catch-up. That vertical candle this morning wasn't speculation. It was realization. And the game doesn't end until prices converge. Even if we get a pullback, even if silver is shoved down to $82 temporarily, the floor is firm. At that level, the arbitrage gap only widens, and the vacuum pulls harder. That's the reality. The chart shows the panic. Shanghai explains the reason. And once you see both, $85 doesn't look expensive anymore. It looks like a clearance sale. At this point, the irony couldn't be sharper. Every instinct the short sellers rely on is now working against them. If they push the paper price down in New York, they don't regain control. They accelerate the drain. The lower the price falls on the screen, the faster physical metal vanishes from Western vaults and boards a one-way trip east. That's the paradox of this market. Price weakness no longer creates relief. It creates urgency. And this is the trap the shorts walked into without realizing the door locks behind them. They are boxed in. If they smash the price, they lose inventory as arbitrageurs scoop up cheap metal and ship it to China. If they allow the price to rise, the mark-to-market losses become catastrophic. There is no elegant exit, no soft landing. Just a narrowing corridor where every decision makes the situation worse. That's why today's behavior feels frantic rather than strategic. And that brings us to the obvious question. Why is China paying $90 for silver in the first place? Why the urgency? Why the aggression? The answer is not speculation, it's necessity. We turn back to the concept most traders underestimate because it doesn't show up neatly on a chart. Inelastic demand. China's economic pivot toward high-tech manufacturing is not a policy memo, it's reality. They dominate solar panel production. They dominate battery manufacturing. They dominate electronic supply chains. All of these industries consume silver, and not in trivial amounts. You can't redesign around it. You can't substitute it easily. You either have silver or the assembly line stops. For years, industrial users relied on just-in-time inventories, assuming metal would always be available at the margin. That assumption has failed. Industrial stockpiles are critically low, and the supply chain shock of the past few years taught manufacturers a painful lesson. Just-in-time has become just-in-case. Chinese firms are no longer optimizing for cost. They're optimizing for survival. They are hoarding inputs because losing access to raw materials is an existential risk. Put yourself in this position of a solar manufacturer in Shenzhen. If you believe silver could be trading at $150 next year, paying $93 today isn't expensive. It's cheap insurance. You're not betting on price. You're locking in production. You're ensuring your factory keeps running while your competitors scramble. That mindset changes everything. These buyers do not sell when the price dips. They buy more. You cannot shake them out. There is no stop loss on survival. This is why the Shanghai price matters more than the paper quote scrolling across Western screens. The $93 price reflects real demand for real metal. The $85 price reflects a leveraged derivatives market still pretending it sets the rules. The gap between those two numbers is the opportunity and the pressure point. But industrial demand is only half the story. The other half is even more destabilizing. China isn't just buying silver for factories, it's buying silver for protection. The Chinese public is watching its property market crumble. Confidence in traditional stores of wealth is eroding. Capital controls limit access to dollars, so savers look for alternatives. Gold has always been the first stop. But as gold prices climb, silver becomes the accessible hedge. It's the monetary metal for the masses. That dynamic is now visible in the Shanghai premium. It's not just manufacturers panic buying, it's citizens voting against their own currency. Every ounce purchased is a quiet act of capital flight within the rules. And in doing so, they are unintentionally dismantling the Western suppression mechanism. Paper markets only function when physical holders remain passive. Once the public demands delivery, the illusion breaks. So when you see $85 on your screen, don't think expensive. Think discounted. You're looking at a price that is already below the global clearing level. You're being offered silver cheaper than what Chinese manufacturers and savers are paying for the same atoms. That window doesn't stay open forever. Arbitrage windows never do. And when they close, they tend to slam shut. Yes, volatility will remain high. Yes, banks will fight this with every trick they have left. But they are fighting gravity. They are fighting physical flows. The magnet at $93 is real, and once price reaches it, the next psychological waypoint isn't subtle. It's $100. Markets don't drift toward round numbers. They collide with them. But while all of this explains the global macro picture, there is something happening on the ground in the United States that is far more immediate and far more uncomfortable, especially if you're trying to buy silver today. Because while the paper market argues over $85, the real market has already moved on. We are now receiving confirmed reports from major U.S. bullion dealers that the physical supply chain has snapped. Not strained, not tight. Snapped. The disconnect between the screen price and the street price has become impossible to ignore. If you walk into a dealer or try to place an online order today, you are not paying $85 for silver. You're paying a premium that rivals the worst moments of the pandemic squeeze. Standard silver rounds are now carrying premiums of $8 to $9 over spot. Do the math. $85.37 plus $9 puts you at $94.37. That's not theory, that's the receipt price. And here is the part that should make you pause. That 94 Spolar Street price in the US is almost perfectly aligned with the 93.31 Shanghai close. The physical market has already repriced. It has already crossed $90. The only thing lagging is the paper contract on the COMEX. The screen is fiction. The coin shop is reality. But even price isn't the real problem anymore. Availability is. Multiple dealers are reporting that private mints, the companies that convert 1,000-ounce industrial bars into retail coins, are now quoting 8-week delays on new orders. 8 weeks, 2 months. This isn't a FedEx issue. This isn't weather. This is a manufacturing breakdown. It means the mints cannot source the silver blanks needed to strike coins. When a mint quotes an 8-week delay, what they're really selling is a promise. Give us your money now, and we hope we can find the metal to deliver later. That's a futures contract in everything but name. It's a sign that the buffer between wholesale supply and retail demand has evaporated. Panic buying over the last 48 hours vacuumed it clean. And then there's the quote that should sober everyone. A senior executive at a major U.S. bullion dealer was asked this morning about inventory conditions. His answer was blunt. Nobody has any silver. No spin, no optimism, just the truth. He went on to warn that if momentum continues, retail premiums could hit $20 or even $30 per ounce. Consider what that means. If spot remains at $85 and premiums reach $30, you're paying $115 for silver. Welcome to a bifurcated market. At that point, the paper price becomes irrelevant to physical holders. Banks can smash the futures price all they want. They can print contracts until the screen says $70. If the premium rises to compensate, the real cost stays north of $110. You can't print physical metal. You can't short a silver eagle into existence. And this is precisely why this situation is dangerous for the banking system. It exposes the mechanism. It reveals that COMEX is no longer a valid price discovery tool. It's a derivatives casino for algorithms. And the public is starting to notice. The retail wave we've been warning about is here. Average investors see inflation. They see debt. They see instability. They want something tangible. But when they go to buy it, they're met with empty shelves and eye-watering premiums. That fuels panic buying. In a normal market, higher prices slow demand. In a shortage, higher prices accelerate it. Buyers fear that if they don't act at $95, they'll be forced to act at $150, or not at all. This is inelastic demand colliding with inelastic supply. Mints can't ramp production because they can't source metal. Buyers won't step back because they don't trust the currency. Something has to give, and it's not the physical market. The paper price must rise to meet reality. If the spread grows too wide, traders will stand for delivery, take bars at $85, and sell them to mints at $95. That arbitrage drains COMEX vaults until there is nothing left. That's not opinion, it's math. So what do? There's no easy answer. Buying physical today means swallowing a painful premium and accepting an immediate paper loss. But the real question isn't about spot price, it's about access. Is it better to pay a $900 premium now and actually own metal, or wait for a better price and risk finding nothing available at all? If premiums really do move to 30, today's prices will look generous in hindsight. This is the unobtainium phase. And once a market enters this phase, it doesn't rewind, it resolves. At some point, price stops being the story. You can argue over numbers on a screen all day long, but if there's nothing available to buy, the sticker might as well be decorative. That's where we are now. What S unfolding looks less like a normal market squeeze and more like the early phase of a run on the bank. Except this isn't T a run for cash. It's a run away from cash. People are trying to exchange paper for resources before those resources are repriced beyond reach. The 8-week delivery delay is the tell. It's the crack in the glass. It's the moment when a system quietly admits it's under stress. And if that delay stretches to 12 weeks or 16, the market doesn't just tighten, it freezes. At that point, silver isn't expensive, it's unavailable. The price doesn't go higher. It goes to no offer. You can't buy it with dollars anymore. You buy it with other assets. Gold, land, productive labor, real things. We're not fully there yet. You can still place orders today. You can still get in line. But the line is moving fast, and the doors are starting to close. The dealer crisis is the canary in the coal mine, and the canary is not doing well. If the mints can't source silver, it means the refiners can't source silver. If the refiners can't get it, the miners are already stretched thin. That tells you the break isn't at retail, it's upstream. The entire chain is under strain, and all the while the chart keeps printing what looks like a vertical thesis statement. Silver at 85 or 37, up nearly 7% in a day. The paper market is smiling politely and insisting everything is fine. The physical market is screaming. Premiums, delays, empty shelves. Those are not the signs of a healthy system. They are the signs of failure. So now we move to the end game, because that's where this is heading, whether anyone is ready for it or not. We take the $93 Shanghai price, the very real possibility of $20 or $30 premiums, and we ask the only question that matters. Where does this actually stop? And more importantly, how do you navigate a market where price and value have completely divorced? If you followed this entire deep dive, you already see the fracture lines. You understand the technical breakout. You understand the arbitrage vacuum pulling metal east. You understand that the physical street price has already broken away from the futures. Quote, "This isn't a strange trading day or a rogue headline. This is systemic. It's the alignment of technicals, arbitrage, and supply failure in a way we haven't seen since 1980. Now we have to look forward, because once an asset clears its old highs and enters true price discovery, the maps disappear. There are no resistance levels drawn on a chart for territory that's never been visited. We're flying into open air. So where's the ceiling? Is it 85, $93, 100? To answer that, you can't use the dollar as your measuring stick. The dollar is no longer a reliable unit. Measuring silver in dollars right now is like measuring distance with a rubber band. The band keeps stretching, so everything looks like it's moving. Instead, you have to think in relative terms. You have to compare silver to gold. Gold today is holding around $4,600. It's up, but it's steady. It's doing what it's supposed to do. Gold is the anchor. Now look at the gold to silver ratio. For most of recorded monetary history, from Rome to the US Constitution, that ratio hovered around 15 to 1. That wasn't arbitrary. It reflected natural scarcity in the Earth's crust and the shared monetary role of both metals. In the modern era, that ratio blew out to absurd levels, 80 to 1, 90 to 1, even over 100 to 1. That wasn't natural. It was suppression. Silver was treated like a disposable industrial byproduct instead of a monetary metal. Now look at today. Gold at $4,600, silver at $85. That puts the ratio around 54 to 1. Still distorted, but collapsing fast. If silver merely returned to its historic monetary relationship with gold, no speculation, no mania, where would it trade? Do the math. $4,600 divided by 15 is roughly $307 per ounce. That's parity. That's fair value in a world where gold is already repriced. At $85, silver isn't expensive. It's early. It's still trading at a massive discount to its monetary role. This is the catch-up phase, and everyone who matters understands it. When gold becomes unreachable for the average saver, capital flows into silver. It always has. It's not called the poor man's gold as an insult. It's leverage. That's why $100 isn't a question of if. It's a psychological waypoint. And humans care deeply about round numbers. When silver crosses $100, something changes in the collective mind. It becomes a headline asset. It hits mainstream media. It stops being that weird metal and becomes a cultural event. That's when the current panic will look quaint by comparison. Which brings us to the most emotionally difficult part of this conversation, selling. Many of you are already running the math. You're looking at your stack and imagining what it could buy in dollar terms, houses, cars, freedom. And that's natural. But you need to slow down and think very carefully. If you sell silver for dollars, what are you actually doing? You're exchanging a scarce, appreciating asset for a currency that is actively losing purchasing power. You're stepping off the lifeboat because the ship still has nicer furniture. The dollar is not the destination, it's the thing being measured and found wanting. We are in a currency reset, but not the kind announced at a podium. This one is happening organically, driven by markets and flows. The signal isn't a press conference, it's the spread. When Shanghai pays $8 more than New York for the same ounce of metal, the market is telling you that Western price discovery has lost authority. This is not new historically. Every major currency collapse tells the same story. Weimar Germany, Zimbabwe, Venezuela. People who sold their gold and silver early thought they were rich until the paper they received became worthless faster than they could spend it. They sold for millions, then billions, then trillions, and still couldn't buy bread. So when do you sell? You don't sell for paper. You sell when you can exchange ounces for income-producing hard assets. This is the ounces to acres strategy. Land, rental property, businesses, energy infrastructure, things that produce value without permission. You wait for the mania. You wait for the moment when real estate collapses relative to silver. Today, it might take 5,000 ounces to buy a decent home. In a peak dislocation, it might take 500. That's the trade. You're not cashing out. You're rotating from one form of generational wealth into another. We are not there yet. At 85s, we are barely off the launch pad. The coming week may be the longest week of your financial life. Volatility will be brutal. There will be smash attempts, rumors, headlines designed to calm you down or scare you out. Ignore them. Watch the real indicators. Is the Shanghai premium closing? No. Are mint delays shrinking? No. Is industrial demand slowing? Absolutely not. The fundamentals are locked. The bridge behind us is on fire. There's no return to $20 silver. That era is over. We are entering resource nationalism. Countries with silver will hoard it. Countries without it will fight for it. And you, as an individual, are standing in the middle of that struggle holding something everyone wants. Don't let them shake you out. Secure your position. Secure your storage. Educate your family. This isn't about getting rich overnight. It's about surviving a transition from a debt-based system to a resource-based one. The dollar didn't collapse with a speech. It faded quietly. Price discovery didn't begin with applause. It began with a spread. And the future belongs to those who understand that paper promises eventually bow to physical reality. Stay steady, stay informed, and welcome to the age of real money.